In the world of finance, there are a few tools that are as powerful and, let's be honest, as confusing as options. They've been around forever, but in the last few years, their popularity has just absolutely exploded. So what's the deal with them?
Well, think about two of the biggest questions any investor faces. First, how can you get in on a massive stock rally without having to put up a huge chunk of cash? And then, on the flip side, how do you protect your portfolio, your life savings, from a sudden, nasty market crash?
It might sound a little too good to be true, but the answer to both of those problems, chasing those big gains and protecting what you have, it actually lies in the very same financial tool. Okay, let's dive into this. That financial tool is called an option. Welcome to Everything You Need to Know About Finance, where we dive deep into the concepts that really move the markets. Now, just a quick heads up, this is a deep dive for informational purposes. It is definitely not financial advice. And hey, if you find this kind of content valuable, do us a favor and take a quick second to like and subscribe. It really helps.
So here's the game plan for today. We're going to start with the absolute core concept. Then we'll get into calls, which are all about betting on a rise. After that, puts, which are like insurance for your stocks. We'll look at how they're priced, the 4 basic plays you can make, and finally, what your next move could be.
All right, first things first, let's strip it all back. What even is a financial option? At its heart, an option is just a contract. But the magic, the whole secret sauce, is in that one phrase, the right, but not the obligation. This means you have the choice, the flexibility. You've essentially bought yourself the power to decide, and that power is what makes options so incredibly versatile.
And every single one of these contracts has 4 key ingredients. You've got the underlying asset, which is just the stock we're talking about. The strike price is that locked-in price. The expiration date is your deadline. And finally, the premium. Well, that's what you pay for this powerful choice.
Now here is a number you absolutely have to remember, 100. A standard options contract almost always controls 100 shares of the stock. This is where all that leverage comes from. For a relatively small cost, you get to control a big position. This is so key to understanding everything else we're about to cover. Okay, with those building blocks in place, let's talk about the first type of option, the one you use when you think a stock is getting ready to launch. This is a call option. A call gives you the right to buy. The easiest way I remember it is you call the stock up. Simple as that. If you're bullish, you think the price is going higher, you buy a call.
Let's walk through a quick example. So imagine a stock is trading at $100 a share, and you have a strong feeling it's going way up. Now, instead of forking over $10,000 for 100 shares, you could buy one call option with a strike price of $110, and you might only pay a $2 premium for that right.
So from there, 2 things can happen. Path number 1, you were right. The stock rockets to $130. Your option is now in the money because your right to buy at $110 is super valuable. Path number 2, you were wrong, and the stock goes nowhere. Your option just expires worthless. I mean, why would you use your right to buy at $110 when you can just buy it on the market for less? So let's do the math on that winning scenario. You use your option to buy 100 shares at your locked-in price of $110. You can then immediately sell them for the market price of $130. That's a $20 gain per share. You subtract the $2 premium you paid, and you're left with an $18 profit on each share. Times 100 shares, that's a cool $1,800 profit.
But what about the flip side? What if you're wrong? Well, this is the beautiful part. Your maximum loss is just the premium you paid. That $2 per share premium on a 100-share contract means you lost a total of $200. That's it. This is what we call limited risk. You knew your worst-case scenario from the very beginning.
Okay, so that's how we play offense. But what about defense? What if you're not hoping for a rise, but you're actually worried about a fall? Well, that's where puts come in. A put option gives you the right to sell at a set price. You buy these when you're bearish, when you think the price is headed down. You can think of it like having the power to put your stock onto someone else at a better, locked-in price. Honestly, this is the absolute best analogy for understanding puts. If you own a stock, buying a put is exactly like buying an insurance policy on it. It's there to protect you if things go south. So let's see how that insurance policy actually works. Let's say you own 100 shares of a stock, and you buy a put with a $90 strike price. If the stock totally crashes down to $70, you're protected. You can exercise your option and sell your shares for $90 each, saving yourself from that big loss. Now, if the stock stays high, well, the option just expires, and that little premium you paid was simply the cost of your peace of mind. So we have calls for going up, puts for going down. It seems simple enough, but how are these things actually priced? Why are some options dirt cheap and others are super expensive?
And that leads to a really good question. If a put lets you sell at a certain price, why wouldn't you just always buy the one with the highest possible strike price to give yourself the best possible safety net?
The answer is pretty simple. Better protection costs more. Think about it like insurance. A policy with a really low deductible is always going to be more expensive. So for a stock trading at $100, a put that lets you sell at $95 offers way more protection, so it's more valuable, and it costs more than one that only protects you below $85.
And this all leads to a really important idea called the break-even price. See, it's not enough for the stock to just move in your direction. It has to move enough to cover the cost of the premium you paid in the first place. So for that $90 put that cost you $1.50, the stock actually needs to fall all the way below $88.50 before you start making a real profit.
Okay, let's pull back for a second and bring this all together. Everything we've learned so far can really be boiled down into 4 fundamental moves.
This table basically sums it all up. If you're bullish and you think the price is going up, you buy a call. If you're bearish and think the price is going down, you buy a put. Believe it or not, almost every complex, mind-bending option strategy you ever hear about is just some combination of these 4 basic actions.
So, we've covered the what, the why, and the how of the basic option building blocks. This isn't the end of the road, of course, but it's a really solid foundation to build on.
So I'll just leave you with this question to think about. Based on what we've covered, which one of these tools seems more immediately useful to you? Is it using calls to get leverage on a stock you think is going up, or is it using puts to buy some insurance for the stocks you already own? The real future, the real power of using these tools isn't just about making these single bets. It's about how you can combine them to perfectly shape your risk and your potential reward. This is just the beginning. If you found this deep dive interesting, try out our latest episodes to explore even more financial concepts.